So in this video, I'm going to talk about how to set up a debit spread or how to trade a debit spread with Questrade. So in the symbol lookup, just make sure you're under option and then look up the symbol that you want. Let's say SPY. And then under calls and puts, you have to choose vertical. So a vertical has two types of spreads. It has a credit spread and a debit spread. So if you want a debit spread, you have to choose vertical. And then you choose your expiration. Let's just say August 19. And then you have to choose if you want a call debit spread or a put debit spread. So if I click anywhere on call debit spread, the order entry updates automatically. I might have to make some adjustments based on the strikes that I want. Now, to be considered a debit spread, you have to pay to get into the trade. So as you can see, this here is a debit spread. If I'm getting a credit to get into the trade, then it's a credit spread. And when doing a call debit spread, in order to be a debit spread, basically the call that you're buying is the lowest call. And then the call that you're selling is the further out call. If you're doing a put debit spread, it's going to be the opposite. The put spread that you're buying is going to be the higher put, and the put spread and the put option that you're selling is going to be the lower. So why do a put debit spread? Why do a call debit spread? Which strikes to choose? How does it work? How do you make money from a debit spread? So let's look at a vertical call spread or a call debit spread first. I'm just going to choose August 21st expiration. So assume I buy the 322 strike for August 21st and I sell the 327 strike for August 21st as well. So it has to be the same expiration to be a debit spread. So same expiration, August 21st. The difference between both strikes is 5 points. So now I would pay about $278 to get into this trade. So if I do one contract, that's $278. So how do I make money from this? So the way I make money from this is if I think SPY is going to move up. If SPY is going to move up and at expiration it closes at 327 or higher, then this trade here that I collected $278 for, I'll be able to sell it for $5. My max selling price will always be $5 if the difference between both strikes is 5. So my profit is capped, and my profit only happens if the stock does something, if it moves in a certain direction by a certain time. My max loss is what I pay to get into this trade. So in this case, my max loss is $275. Or whatever I pay to get into this trade. So that means my max return really is about 100% because the max profit I can make is $5 minus what I paid. So about $2.30. So that would be my max profit in this case. And that happens only if SPY goes above 327 by August 21st. If it happens before August 21st, if it moves up slightly, maybe it'll be worth 350 and I could close it for a profit as well. So I don't necessarily have to wait till expiration, but the way I make money with this call debit spread is the SPY has to move higher. Whether it's trading at 340 or 350, my max profit will always be the difference between the strikes. So 327 minus 322 is 5 minus what I paid. That'll be my max profit regardless how high the SPY is trading above 327. If the SPY drops as soon as I buy it, then I wouldn't be able to make money and my 277 that I paid will start dropping in value and I could potentially lose everything that I paid. If SPY closes at 322 at expiration August 21st, then the call option here that you could see on this line, leg 1, that I paid $692 for, it's going to be worth 0 at expiration. So it's going to be out of the money. And this 327 that I sold for $4.18 will also be worth 0. So the whole spread itself will be worth 0, and therefore I'll lose my $277 that I paid. A debit spread is very similar to buying a call on its own. So you have the same assumption. You think the stock is going to go up, so you want to buy a call to take advantage of the leveraging power of an option. But instead of paying $691 for that call, you decide to help finance it by selling a call option a little bit higher. So what that does is by selling that call option a little bit higher, it helps you lose less in case you are wrong. So in case SPY drops and never goes above your 322 call, then at least you lost $2.70 instead of losing $6.80. The other thing it does is that it caps your profit. So it's a trade-off. You pay more to get in, but you have a higher potential of profit, or you pay less to get in, but your profit is capped. But if you were to buy the call option alone and you paid $6.90, for you to start making money, SPY at expiration has to be trading 322 plus SPY at expiration has to trade above 322 plus 691 for you to start making money. Anything below 322 plus 691, you start losing money. Your break-even zone is better when you have a debit spread. Now, what were to happen if we change the strikes? What if we go to 315 strike and 320 strike. So you can see the 315 strike is in the money, so it's below the current market price. The 320 is also in the money. I'm going to end up paying a little bit more. I'm going to end up paying $3.50. In the other example, I was paying $2.80. But this way, I have a better chance of winning, because as long as SPY is over 320, then I achieve max profit. So I'm giving myself a better chance of winning because my break even starts lower and my profit zone starts lower as well. In fact, it starts lower than the current market price. While in the other example, my break even starts above 325 about, and my profit zone, my max profit is achieved at 327. But in this case, I pay more to get in. My max profit is the difference between both strikes minus what I paid. So my max profit is $5 minus $3.50, so $1.50. Now the same is true if we go way out of the money. So let's say I pick a 325 strike that I buy and I sell the 330 strike. You can see I'm paying a little bit less than the first example. In the first example, I was paying $2.70. Now I'm paying about $2.30. So my max profit is a little bit higher. It's about $2.70. But for me to achieve max profit, it's a little bit harder because now max profit happens if SPY is above 330 come August 21st. So you could see the different strike selection, how it affects your profit zone and your potential of making profit, your probability of making a profit. So let's say these were the strikes that you wanted to choose. You simply put in your price here that you want to pay. Then you click send order and then you confirm everything. So buy to open the 325 call and sell to open the 330 call. So remember, a debit spread for a call debit spread, the strike that you buy is the lower strike and the strike that you sell is the higher strike, which makes sense. And then you just click send order. And once it gets filled, you'll see it in your positions tab. And you can, if you want to sell it or close the trade, simply make sure that you're grouped by strategy over here. You're going to have a create order button, which I can show you in a different account. So you'll have this create order button only if you're grouped by strategy. So if your strategy is a debit spread, it'll say debit spread over here instead of covered call. You click create order. It'll automatically give you the closing entry for this trade. So you simply choose your selling price. You'd want to sell at $5 if that's your max profit. Put in the $5 and click send order. Make sure in the order confirmation window it says buy to close and sell to close. Now a put debit spread is the exact same thing but with a different assumption. You think the stock is going to drop, so you're going to buy a put debit spread, and it's the same thing. So you go to vertical, make sure you're under option, choose your expiration, August 21st for example, and this time we're going to click on the put side. We're going to click on anywhere on the put side. And then we're going to choose our strikes accordingly. So right now SPY is at 321. So same concept. If you're doing a debit spread, so the strike that you're buying has to be, in the case of a put, has to be higher because you want to pay more. And the strike that you're selling is lower because you're collecting less. So if we do, for example, if I choose a strike of, let's say 325 and we sell a 320 strike. So you can see that I'm paying $8 to buy the put option and I'm selling the 320 strike. I'm selling it for $6. So the net combination makes me pay only $2. So I'm using the put option that I'm selling to help finance the put option that I'm buying. But my assumption is the same. My assumption is the stock will drop. So how do I make money from this? The stock has to start dropping. And at expiration, it has to be below 320. And if it's below 320 at expiration, my max profit once again will be $5. It's a difference of the strikes minus what I paid. So my max profit on this one would be $3, and it is achieved if SPY is trading below 320 come expiration. So let's say we pick the 330 and then the 325 strike. So they're both out of the money. So you can see I have a better chance of winning. As long as SPY is trading below 325, I win. SPY is at 321 right now. So I'm giving myself a better chance of winning. And that's why I'm going to be making less profit. So I'm paying more to get into the trade. And my max profit is a bit less, about $2.30. Now, if I really think SPY is going to drop to 300, I could buy the 305 strike and then sell the 300 strike. You can see I'm going to pay 66 cents to get in, but my max profit is $4.40. And that happens if SPY is trading below 300 come August 21st. So obviously I've got a smaller chance of that happening, but if it does happen, I'm going to get paid nicely. So that's the trade-off when you choose your strike selections. But it's important to know what your max loss is and what your max profit is, and why you would do a spread instead of just buying the call on its own or buying the put on its own. When you do a spread, you help finance the naked option position by selling the other option, and your profit zone is easier to achieve, but you sacrifice more profit. So if I go back to the call example that we started with, so August 21st, so let's say I buy the 320 and I sell the 325. So right now it's trading for about $3 almost. So I'd pay $3 to get in. That means my max profit is the difference, 5 minus 3. So $2 would be my max profit on this trade. So let's say on August 21st, SPY does close at around 322. Let's say closed it at exactly 322. So that call option that I paid $8.11 will be worth $2 because it's only $2 in the money. 322 minus my 320 strike is $2. So this call option will be worth $2. This call option here that I sold for $5 will be worth 0 because it's out of the money. 325 is higher than 322, so this one will be worth 0. So that means my max selling price will be $2, but I paid $3. So I only lose $1 in that case if SPY closes at 322. If it closes at 325, that's when I achieve my max profit. Why? This option is going to be worth $5 because 325 minus 320 is $5. So the 320 strike is $5 in the money. So it's going to be worth $5. And the 325 strike is going to be worth $0. Because if the stock closes at 325, then my 325 strike is worth $0. Net combination, my max selling price will be $5. 5 minus 0. So that's how I achieve max profit. Let's say it closes at 330. Let's say SPY closes at 330 come August 21st. My 320 strike will be worth $10. 330 minus 320. My 325 strike will be worth $5. 330 minus 325. So I've got $10 here. I've got $5 here. But I initially bought this option, so I'm going to have to sell it to close it. And I initially sold this option, so I'm going to have to buy it back to close it. So I'm selling this for $10 and I'm buying this for $5. So 10 minus 5, $5. So once again, max profit, $5. So my max profit will always be $5, or my max selling price, sorry, will always be $5 as long as SPY is trading above 325. So personally, I prefer to sell credit spreads than to buy debit spreads for one reason only. When you buy a debit spread, first of all, you have to pay money first. When you sell a credit spread, you're collecting money. But when you buy a debit spread, for you to make money, something has to happen to the stock. It has to move in the direction that you predicted, and it has to do it by a certain period, which is the expiration that you choose. So I'm not good at predicting direction. I don't want to try to be good at predicting direction. I don't think it's something that can be sustainable or I can be consistent at. So buying a debit spread would mean that I'm making a directional assumption and it has to happen for me to win. When I sell a credit spread, all I'm saying is the opposite. Basically, I'm saying move wherever you want, just stay below a certain price and I'm good. So just to show you a quick comparison, if I'm selling a call spread, let's say I sell the 330 call and I buy the 335 call, this is going to be a call credit spread. And I'm getting a credit to open this trade. I'm collecting $1.50 to open the trade. That's money that comes in. How do I keep this money? As long as SPY stays below 330 come August 21st, I keep all this. I don't have to predict the direction. SPY can go up, it can go down, it could go to 329, it could go to 315, it could stay put at 321, and I still make the same profit. So this is the opposite. My max profit is capped at what I collected. In the other scenario, in the debit spread, my max loss is what I pay. In this case, my max profit is what I collected. In a debit spread, my max profit is the difference between the strikes minus what I paid. In this case, my max loss is the difference between the strikes minus what I collected. So my max loss here is 5 minus $1.50. So it's $3.50 is my max loss. And my max loss occurs if it's above 335 come expiration. That's why I have a preference to the credit spread, but it doesn't mean the debit spread doesn't mean that the debit spread is a bad trade. I mean, a lot of people make good money with debit spreads as long as you're good at predicting direction, short-term direction. Now, to be able to trade debit spreads with Questrade, you need at least level 3 options with your account within a margin account. You cannot do debit spreads in a register account, only in a margin account with level 3 options. And if I click on level 3, you could see minimum balance required to place a trade is $5,000. So you need at least $5,000 Canadian equity in your margin account to get approved for level 3 options and to be able to do debit spreads. And you can see here long or short vertical calls or puts. That's debit spread. And to choose your level 3 options, it's under account management. All right, so if you have any questions, leave them in the comment section below. And like always, if you can open an account with Questrade to trade on stock market, use one of my referral codes below. One of them gives you up to $250 back depending on your deposit. The other one gives you $50 in free trades regardless of your deposit. And if you enjoyed this video, click the like button, share with a friend, and subscribe to the channel. Thanks for watching.